Episode 5, Risk Management. How to protect your investments. In this episode, we'll explore risk management, one of the most important concepts in investing. Understanding risk and knowing how to manage it is key to preserving your capital and growing your wealth over time. Understanding investment risk. Investment risk is the chance that an investment's value will not perform as expected. It can manifest in many forms such as market risk, stock market fluctuations, interest rate risk, bond value changes due to interest rate movements, or liquidity risk, difficulty in selling an asset at fair value. There are two main types of risk. Systematic risk, the risk inherent to the entire market or market segment. This includes risks such as recessions or natural disasters that can affect the entire economy. Unsystematic risk that affects a specific company or industry, such as poor management or legal issues. Measuring risk. Volatility, a measure of the variation in the price of an asset over time. Higher volatility typically means higher risk. Standard deviation. This is used to quantify how much an investment's returns can deviate from the average return over time. The higher the standard deviation, the riskier the asset. Beta, a measure of how much an asset's price moves in relation to the market. A beta greater than 1 means the asset is more volatile than the overall market. Risk and return trade-off. The relationship between risk and return is central to investing. Higher risk investments generally offer higher potential returns, but they also have a higher chance of loss. Risk tolerance. Understanding your personal risk tolerance is key to making the right investment decisions. This can be affected by factors like age, income, investment goals, and emotional comfort with market fluctuations. Diversification as a risk management tool. Asset allocation. Spreading investments across various asset classes like stocks, bonds, real estate, and cash can reduce the overall risk of your portfolio. For example, when stock prices go down, bond prices may go up, balancing your portfolio. Sector and geographic diversification. Investing across different industries, tech, healthcare, energy, etc., and regions, domestic and international, can provide further protection. Rebalancing. Over time, the asset allocation of your portfolio can shift due to differing returns across assets. Periodic rebalancing ensures your portfolio aligns with your long-term goals and risk tolerance. Hedging against risk. Hedging is a strategy that involves taking an offsetting position to reduce risk. This could include using options or other financial instruments to mitigate potential losses. Examples of hedging. Options. You could buy put options to protect a stock investment from a price drop. Inverse ETFs. These are designed to move in the opposite direction of a specific index or asset, allowing you to hedge against market downturns. The importance of an emergency fund. Having a well-stocked emergency fund, typically 3 to 6 months' worth of expenses, helps you weather unexpected financial hardships without needing to sell investments at an inopportune time. Protecting against specific risks. Interest rate risk. Bond investors should be aware of how interest rate changes can affect the value of their holdings. Long-term bonds are generally more sensitive to interest rate changes. Inflation risk. Inflation erodes the purchasing power of your money. To hedge against inflation, consider investing in assets that tend to do well during inflationary periods, such as real estate or commodities like gold. Thank you for watching. Please like and subscribe for more money tips.